Today we'll be looking at a balance day adjustment. This question is from the 2009 past exam. So I've already drawn up an extract from a trial balance for this business. So an extract means that it is not all the balances from the balance sheet and income statement, just a few. So I will be going through the adjustments that are needed from this unadjusted trial balance. So the first transaction is a stock reveals 14,000 of inventory on hand. If we look in our ledger, we have no inventory account. Because that's the case, all we do is we need to write inventory down here, and the balance is 14,000. It is an asset, it's debit in nature, so it's 14,000. If we had inventory in the ledger account, we'll need to find out if it's a gain or loss on sale and then make the appropriate adjustments. That is it for that transaction. Then the next transaction, an annual insurance premium for $1,800 was paid on the 1st of May. So we draw a timeline. 1st of May. We paid $1,800. Here is balance day. So between here and here is May, June. There are 2 months, which means we've got 10 months as a prepayments. So we paid it here. We only need to record 2 months for this accounting period. The rest needs to go as a prepaid. Okay, so it's $1,800, and that is for insurance. So if we look, we already have insurance in here for $1,800. That's the total amount that we did pay on the 1st of May. So if we do a calculation, we do $1,800 times by 10 months over 12, we'll get 1,800 times by 10. That 1,500 is our prepayment. So what we need to do is cross this amount out, and we can work out that with 300 here and 1,500 here. So this number needs to be 300 from here, and then we're going to have a prepayment, prepaid, insurance, and that is going to be, we've decreased this by 15, so this is going to be increased by 15 to make the debits and credits equal. And that is that transaction done. Next one, furniture and fittings are depreciated at a rate of 10% per annum on a straight line method. A 4,000 display cabinet was purchased and recorded on the 1st of April. So we had an extra 4,000 on the 1st of the 4th. So there's 2 parts to this transaction. One is we need to do the depreciation with the amount that's already in there. Secondly, we need to depreciate this amount only for the portion that we own the asset. Now, in the other information, it says cabinet was purchased and recorded. So if we look under furniture and fittings, this 4,000 is already in this amount. So the historical cost of the assets is $11,000 before we bought the new furniture and fittings. So what we need to do is depreciate this using straight lines. So we're just going to times that by 10%, and we'll get that the depreciation is 1,100. But then we've still got to do the depreciation for this one. So the depreciation of the new asset is 4,000 times by 10%, giving us 400. But that's for a whole 12 months, and we've only had it for April, May, June. We've had it for 1 quarter. So we're going to times this by 3 over 12, giving us $100. This means our total depreciation is this amount plus this amount. Total is 1,500. So we now need to record that into our adjusted trial balance. So remember, with our depreciation, we do not change the cost base of the asset. We add it on to the accumulated depreciation. So we need to cross this out, and we need to increase that by this amount. So this is going to be 5,000. I did a mistake here. That will be 1,000 is 1,200. 1,200. And then over here we're going to write depreciation, furniture and fittings, and it is 1,200. That is that one done. Next one, kitchen equipment is depreciated at 5% per annum using diminishing. So with the diminishing method, we must use the book value. So if the kitchen is, the historical cost is 30,000, the accumulated depreciation is 10,000, so the book value is 30,000 minus 10,000 gives us 20,000. And we just 5% of that amount. And that will give us $1,000. Make sure I write. Yep, 1,000 is our depreciation amount for the kitchen. So we need to add that onto the accumulated depreciation to make this 19,000, whoops, not 19, 11,000. And then we need to make a new account called depreciation kitchen, because we want to itemize the accounts. That is 1,000. We've done that one. Advertising for the period is 1,900. So advertising equals 19. Now if we look into our ledgers, we've got prepaid advertising. So this is method B in our textbook. So we need to record our advertising, there's no advertising expense here, to be 19,000. Advertising 1900, sorry, 1900. So this 1900, so we've increased this by 1900, this account, because it was 0. So that means we need to decrease this account by 1900. So 3,500 minus 19 gives us 1,600. And that's our debits and credits should equal then. An allowance for doubtful debt is 5%. So we want an allowance for doubtful debt of 5%. Doubtful debt. Okay, allowance. So you always got to remember that you've got to look, do we have an allowance account first? And if we do, we must transfer the bad debts to the account before doing this transaction. In this case, we don't. We do not have an allowance. So all we do is we take 5% of our debtors. So we want 7,500 times by 5, and that will give us 7.5 times by 5%, 375. So we need to record that. So an allowance for doubtful debts for DD and our doubtful debts, because they are the two transaction debts. So allowance for doubtful debts is debit in nature. That will be 375, and the allowance is credit in nature, 75. And remembering when we do these transactions, this one here, these two are linked in our balance sheet, in our current assets. This is a contra account. It is a negative current asset. It's a contra account. That's that one. And the last transaction, $200 interest from government bonds is owing. So this here is interest revenue. So we have interest revenue. Of 200, so we need to record that in our income statement. And the other part, it says it's owing to us. So we have not received it, but we have earned it. So that's what we call accrued revenue. And that is 200. So this here would be a current asset. Okay, so they are the adjustments you would have to do for the 2009 exam. Then the second part of the question is preparing the journals, and third part,